Greetings and welcome. Dr. Scott Dell at your service. Excited to be here presenting for East Oregon University. Statement of cash flows. How do we prepare one of those things? So I'm going to go ahead and share the screen, and I do have a PowerPoint, but I'll also do some live demonstrations as we go. So preparing the cash flow statement is our topic based on the book by Wild, 8th edition. And it is chapter 12, which is where I'm drawing the most of the material from, but I'll be interjecting my own material as well. Two items in blue I bring your attention to. We have the LinkedIn address, so I invite any and all of you to connect with me on LinkedIn. I would welcome that opportunity. But also, there's a tiny URL, the EOU cash flow. You have full access to this presentation. Don't have to make a lot of notes. You don't have to really memorize the slides. You can go straight to the tiny URL, or even better yet, click on the QR code or the tiny URL, and you will have this full presentation at your disposal. So let's go ahead. I'll give you a second to take a picture of that if you like. And we're going to take a look at the agenda. Where are we headed? Well, we're all about preparing cash flow statements. Show me the money. We're going to talk about the importance, the why cash flow, and we'll get into the presenter, me, as well. I'm going to go on live to the Security Exchange Commission's EDGAR site. It's the place where we have access to all annual reports, all 10-Ks and 10-Qs, quarterlies as well, for any U.S. publicly traded company. SEC collects all that good stuff. We're going to go live and see a live discussion and see a cash flow statement up close and personal. And then we'll talk about OIF, operating, investing, and financing categories, sources and uses of funds in each of those three categories, the importance of what they mean, and which of those might be the best future predictor of performance. I will say we're going to emphasize the indirect method. Direct method is good, a lot of transactions. Indirect method is a little bit easier to process. And frankly, most publicly traded companies use the indirect method anyways, which is why we'll emphasize it here. We will not be going in any depth of the direct method. We'll mention it, but not do a deep dive. We'll actually prepare a statement of cash flows. We'll draw some conclusions, and we do have a final exercise to go with this. But first of all, I got a couple of questions. We'll start with, how do you make $1 million in the restaurant business? You might say, well, we get good food, good customers, repeat customers. We do portion control. We manage the waste. We manage the business. We take care of our employees, take care of the operations. But kind of a tongue-in-cheek answer, let's start off with $2 million. I had a restaurant up in Door County, Wisconsin, northern Wisconsin, 5-6 years, very successful. But the catch was, restaurants are tough businesses to make a living, tough businesses to be profitable. And not to scare people away, but the failure rate is high for all businesses. On average, 20% businesses will fail in the first year here in the US, 50% will fail by year 5, and almost 2/3 by year 10. That's not to say don't go in business, but you want to have cash flow managed to help you understand and monitor the business to maximize the possibility that you will stay in business. So a little bit of background on me. 2019 doctorate. I got a Morton MBA and a second master's in education technology. Also a Navy veteran, but I have a lot of accounting experience. Big Four roots with EY as an auditor and a consultant with Grant Thornton, Boston for EY and Madison, Wisconsin for Grant Thornton. But I have been a full-time academic for 16 years. So you're saying you've been a lot around more than 16 years. Well, I've been pretty entrepreneurial. I had a bunch of businesses. Also, I have awarded the WSEPA, Wisconsin Institute of CPA's Accounting Educator of the Year Award, and a couple of books under my belt. Your Complete Guide to Succeeding with LinkedIn a couple of years back, and just in the past 2 months, Living Your Dream Career and a Workbook to Accompany I co-authored with a colleague. But I want to go into cash flow statements. And we're going to start, I'm a GPT-4 fan and AI fan, and I actually do a bunch of talking and discussions about it, help people use it. But I'm going to use it here right now for our class. So the question is, why is it important to understand cash flow? Well, let's ask GPT-4 and see what it says. And here's the prompt. You're an accounting professor with over 20 years of experience. You're seeking to explain the importance of the statement of cash flows to an undergraduate class. Please discuss its importance and its preparation. So let's go ahead and take a look at our prompt and put it into GPT-4. So here's a GPT-4 screen. ChatGPT 3.5 is free. GPT-4 is free with Bing, but I actually do have a paid subscription, and I think it's well worth it. I'm going to put the prompt here, and let's see what it generates when we ask it. So it says, okay, and it's probably going to start with the word certainly. There it goes. If he says certainly, you know it's GPT-4. Okay, as a tax professor extensively, our approach explaining the importance of preparation of statement of cash flow here like so. Understand cash position. Crucial because it shows how much cash a company generates and uses, unlike the income statement. The catch is an income statement. You can be profitable on GAAP, $1 million in revenues and $100,000 in expenses, and you have $900,000 profit. That's cool until you realize that your $1 million is all in the form of receivables. And if you have to pay $100,000 in expenses trying to pay payroll, pay your rent, your employees aren't going to take your receivable. Your landlord is not going to take your receivable. Your suppliers won't take your receivable. Cash flow is king and queen of crucial importance. So financial health assessment, that's important. Cash versus profit, we talk GAAP versus cash flow. Investment and financing decisions. Yeah, we want to know, well, we'll talk about OIF, operating, investing, financing in a minute. Operations, mainstream stuff. Investing, the equipment we buy and maybe invest in other companies. And the financing, the issue of debt, as in bonds payable, issue of equity, issue of stock. Comparative analysis, we want to see how we're doing compared to competitors and how do we do compared to ourselves last year. Predicting future cash flows. Do we want to invest in other businesses, buy more equipment, expand staff, hire new employees? Well, it's all going to be dependent on the cash we have to pay those. How do we prepare? Start with net income. The first item is net income. Better match your income statement. Then we have adjustments of non-cash items. Okay, so depreciation expense, we deduct to get net income, but we have to add that back because that's non-cash. We'll see how some of those other non-cash items fit in the flow. I've already mentioned operating, cash inflows and outflows from primary business. Investing, that's from purchase and sale of assets like equipment, PP&E, property, plant, and equipment, or other investments. And then financing. We're borrowing money or we're actually issuing stock. Or we're buying back treasury stock possibly. You mentioned it mentions the direct and indirect method. We're going to emphasize indirect all the way. Reconciliation of net income to cash flow and presenting in the final statement. Okay, teaching approach, it has some suggestions, some real world examples. We're going to do that actually. Interactive exercises, we got an exercise at the end, some visual aids. Hopefully you'll see some of the PowerPoints that give you hints, tips, and ideas. And I'm your guest speaker, so enjoy it while you can. Every time, by the way, if you ask the same prompt, you get a different answer. If I ask this question 3 times, I'll get 3 different answers. But that's the way AI works. So let's go ahead and head on back to our PowerPoint and see where we're heading with all this. So I'm going to go back to PowerPoint, and we're going to go some learning objectives. We're going to distinguish between operating, investing, and financing activities. And the importance. Well, we just talked about importance. GPT-4 gave us some pretty good answers. Users decide if a company has cash to pay its debts and obligations. I think that's kind of important. I guess you do too, I hope. Evaluate companies' ability to pursue opportunities. Can we buy equipment? Can we hire some more folks? Do we invest and buy another business? Managing and planning day-to-day operations and long-term investment decisions. So let's talk about these 3 sections: operating, investing, and financing. And I'm actually going to go over to the whiteboard and see what we can do with that whiteboard. So I'm going to take a look here, and we're going to have a balance sheet. You've seen these before, which has assets, liabilities, and equity. I have an income statement. We're going to have some revenues, we're going to have some expenses, and we'll have our bottom line of net income. But I want to go a little deeper dive here because we have 3 categories. OIF, we called it operations, investing, and financing. And had mentioned that current assets and current liabilities, things like inventory, receivables, we sell stuff, people owe us money, they pay us. That is really operations. Cash flow from operations. We might have sources and uses, ins and outs. And then we have non-current assets or long-term assets. And those are the things we buy like equipment. Those are the things that we invest in other businesses. And finally, we have our debt, like bonds payable, and equity, our common stock, and additional paid-in capital, all financing stuff. So let's do a little bit of a deeper dive and try to understand where we have increases and decreases. Now, you remember, you know what? Debit and assets, an increase. Credit liability or equity is an increase. Credit revenue is an increase. Debit expenses, an increase. Credit expenses decrease. credit assets decrease, debit liabilities equity decrease. We're going to do something similar when it comes to our indirect method of creating a cash flow statement. So let's take a look at something like inventory. If inventory increases, is that a source or a use of funds? Well, how does inventory increase? We buy inventory. Well, that sounds like a use of funds to me. How about accounts receivable? If our accounts receivable decreases, why would our accounts receivable decrease? Oh, somebody paid us. That's a source of funds. That directly affects cash. So you start seeing increase in asset is a use, decrease in assets a source. How about something like accounts payable? Well, if I decrease my accounts payable, how do I decrease accounts payable? Oh, I write the check. Is that a source or use of funds? Well, that sounds like a use to me. How about if we have a notes payable, we issue a note, or let's go one step further. Let's do a bond payable. We get some folks saying, here's some money. Pay us back later. Give us a 10-year bond. So I just increased my bonds payable account. Did I get cash a source, or did I use cash and spend it? Okay, someone gave me money. I issued a bond. Oh, I got the money. So that's a source. How about equity, common stock, additional paid in capital? Okay. If I increase my common stock, just like my liability, it's a source. If I buy back treasury stock, okay, I'm going to decrease my equity. It's a contra liability, a contra equity account. So it's reducing my cash, credit my cash, and debit my equity. And what's going to happen? That's a use of funds. I had to buy the stuff back. So the same way our assets increase is a use, our asset decrease is a source, our liability and equity increase is a source, and a decrease is a use. That's going to come in real handy when we're trying to figure out how this fits on a cash flow statement altogether. So let's go back and let's go see our PowerPoint again. Oh, I got another question for you though. Take a look at these companies here. You tell me what's similar. What do these companies have in common? Spotify, Uber, Lyft, Peloton, even Uber Eats. Well, catch is not one of these has shown a profit since they began. Pandora for 22 years, Spotify for 16 years, no profit, no annual profit. How the heck do they stay in business? I assure you, not profit means from operations, net income. They're losing money. They're buying and they're investing in stuff. Spotify last year spent a whole bunch in R&D, and they just had another layoff. So they're projecting 17% layoff. But the key is, you know what? They're attracting some money from somewhere, and most of it is by financing. Somebody's buying their stock. And then they're using that money to fund the losses that they seem to have or do have. How about these companies? Amazon, Twitter, well, we're a polite company. We won't talk about that. Tesla. These companies are making a profit or have made a profit, but Tesla went for 17 years without a profit. 17 years? Who the heck would buy a company that's been losing money for 17 years? I wish it was me. If I could have bought them 10 years ago, 15 years ago, I'd be fat and happy. CNN, Twitter, Zoom. Amazon lost money for 9 years. How did they survive? It wasn't from operating cash flow, but it was from financing cash flow. And people were able to put the money in. There we go. Well, let's talk about Edgar for a second. Some of you are probably familiar with Edgar. SEC has full access to all financial statements, all annual reports called the 10K. And we're going to do a Google search on Edgar. We're going to use a ticker symbol for Nike, good Oregon company. Choose classic version. We use the upper right-hand corner. That's a technique that we'll use on the Edgar site. A filing type of 10K, the annual report. And then we'll look at a balance sheet, income statement. Actually, we're going to mainly look at the cash flow statement. And there's something called a view Excel document that's kind of cool. All right, so I'm going to go out and I'm going to go over here and I'm going to go over to the Google search. And under my Google search, I can type in Edgar. And there we go. Edgar Search and Access. It's www.sec.gov/Edgar. And then I'm going to go under company or fund name. There we go. And I'm going to click on NKE. NKE, and hopefully there it is. Nike will pop up. Nike Inc., NKE. Oops. And there it is. Yep, Nike Inc. And in the upper right-hand corner, you'll see this thing called Classic Version. That's kind of important because it gives me some instant access. Filing type, I'm going to type in 10K, and it's probably not going to do very much because if I say 10K, it says nada. How about if I say 10-K? Yeah, the syntax is kind of important. There it is. Annual report filed July 20th, 2023. Going to go to interactive data. And here's financial statements. Now, there's a cool feature here called View Excel Documents. You can get all of these financial statements in an Excel document and do your number crunching to your heart's content. I'm just going to look at it and show tell here, consolidated statement of cash flows. So let's look at the statement of cash flows, 3 years worth, just like an income statement, which is what Edgar does, 2 years of balance sheet, 3 years of income statement. On my birthday, May 31st. Cool. Net income. Well, they were the most profitable in 2022. That's nice. They were least profitable in 2023. That's not as nice. But look at their cash flow from operations. Their highest level was 2021. Their next level was this past year, 2022, and 2023 rather, May 31st. And then least was their highest level of income at $6 billion. They had $5 billion in operating cash flow. Now they had other cash flows, negatives on investment, which past 2 years and the current most recent, and they had negative on financing, and pretty substantial negative here of $7 billion, which probably has something to do with why their cash went down at year end. We'll see that in a minute. So we start with net income. That's our cash flow statement. Income statement starts with revenues. Balance sheet starts with assets and liabilities. Cash flow is very clear, net income. And then we're adding depreciation. Wait a minute. We deducted depreciation expense, which means we have to add that back. Okay. Stock-based compensation. We had deducted that. We're adding that back. Amortization, same thing. We deducted, add back. Foreign currency adjustments. Then we had a decrease in AR. What happens if to decrease in AR? Well, we got a positive 489 million. It is in millions. So that means, yeah, we got people paid their bills. Our AR decreased. But how about inventory? In parentheses, we had an increase in inventory. Okay, so that was a use of funds. That was a deduction of less available funds. So we bought the inventory basically. So you can look at that way again, the increase and decreases based on that whiteboard that we walked through. Investing activities. We had 2 heavy years of heavy investment spending on cash flow. But this year we had a net positive cash flow out of investing, but we had a major negative cash flow out of financing. And biggie here is we were purchase of common stock. Over $5 billion of common stock was bought back by Nike. That's the biggest item there. So cash combine it with $2 billion in dividends. And now we have our cash flow. The other thing to point out is if you look down here under cash and cash equivalents at the beginning of the year, cash and cash equivalents at the end of the year, those better match the balance sheet. Ending last year, 8,574, I bet that's the balance sheet, and 7,441, that's also on the balance sheet for the current year. And our net income better match. Our $5,070,000,000 better match our net income on the income statement. So that's a live demonstration of cash flow statement. And that's a Nike's, well, but they're talking billions. They're talking like, yep, everything's in millions. So add 6 zeros to all this good stuff. And we have a lot going for us. All right, so let's go back to our PowerPoint. And operating, we've talked about operating. We buy stuff, we sell stuff, our mainstream business, current assets, current liabilities. We talk about investing, and we, again, buy equipment, invest in other companies, or sell equipment and sell off our investments. And finally, financing. Financing comes out of issuing debt or issuing equity, issuing stock. Okay. How do we prepare a statement? Well, we need a comparative balance sheet. We got those 2 cash balances. We need our income statement, which shows our net income and our non-cash items like depreciation, like amortization, like gain on the sale of assets. And this is a little better picture than the whiteboard I did, a little cleaner. You see the pink, the current assets and current liabilities, operations, operating cash flow. Our long-term assets, investing cash flow. Our long-term liabilities and equity, that goes with our financing cash flow. And what are we doing? Preparing the statement. Compute the increase or decrease in cash. Thank you, balance sheet. Net cash from operating activities, net cash from investing activities, net cash from financing activities. And we record those based on the indirect method, which record changes. That's a statement of cash flow. Again, it does start with net income. All this just shows operating, investing, financing. And I do have a slide that will, yeah, we got direct method. Great. Cash from customers, paid for merchandise, paid for wage. We don't want to go through all that level of detail. It is a lot more work than just saying, well, did my inventory change? What did my receivables change? My payables, my equipment, every balance sheet item. Let's take a look at the change. And as an exercise, I did want to show you that we have Fitz Company, selected data, net income, depreciation. So what do we do with depreciation expense? Do we have to deduct that again? Or do we have to add that back because we already deducted it on the income statement? Okay, obviously we have to go ahead and add that back. Gain on sale of plant assets. We recorded a gain. We have to deduct that gain on sale of assets because that was a non-cash gain. Anything non-cash goes first. Then we have a receivable decrease. If the receivables decrease, oh, we got paid. Yeah, that's a source of funds. That's a plus on our cash flow from operations. Inventory decrease, same sign, same idea. Okay. Asset prepaid expenses. So here's what it looks like. Start with net income, add back depreciation expense, add back amortization, deduct our gain on the sale because that was a non-cash gain. Decrease in AR, plus. Decrease in inventory. Okay, we sold more than we bought. Increase in prepaids. Okay, our prepaids increased. We haven't used them up as an asset. So when we have an increase in an asset, it's a use of funds. Accounts payable decreased. How did they decrease? Oh, we must have wrote the check. How about an increase in salaries payable? Oh, we haven't written the check yet, but we will. When we write the check, okay, great. Our salaries payable will decrease. When that decreases, that's going to be a use of funds. But until then, that's a source of funds. So a couple of final thoughts. We're in storyteller mode. We're telling the story of cash flow. We need that story to be told so we can make decisions for our business and be some more successful. It is a key statement in our bag of tricks. Yeah, income statement is important. Balance sheet is important. Retained earnings and stockholders' equity is important. Cash flow is king and queen. It tells a story, and we're telling the story here. I'll share with you my email address. I'll share with you my LinkedIn address. My phone number is 608-446-1000. Feel free to call as well. If you have any questions, any comments, any feedback, welcome the opportunity to be of service. That is the presentation. I thank you for your indulgence and your time. Hopefully you learned a thing or two, or if you already knew a thing or two, maybe you got some interesting insights and some additional ideas. Appreciate the opportunity to be of service, and I will look forward to our next encounter. Thank you for your time.